talks about construction contracts. Now, what is this standard all about, or why this standard has come into the picture? So any element related to construction is covered over here. So any construction contract comes into the existence, this standard comes into the picture. Now the thing is, if you could remember some of the standards, for example, AS2, it specifically excluded work in progress under construction contract. If you now think about AS9, which is about revenue recognition, it excludes revenue to be recognized out of construction contract. So construction contract is one specific accounting standard where anything and everything related to contracts or construction contracts are covered over here. So now, since it is a specific accounting standard, overall requirement of all the construction contracts are covered over here. Now, why or what is more important in this particular situation? The more important stuff in this standard is how to recognize revenue. Whenever there is a construction contract, how do you get your revenue or how do you bring up your revenue? From revenue, automatically interconnected profits will also be decided. So majorly it talks about how do you recognize revenue. Now, why does it talk or give more importance to the revenue segment? Because when it comes to this type of contract, the contract runs for a minimum of 1 year. So it goes beyond 1 year for sure, because it's a huge contract which is normally dealt with. So because of that, since the time considered is for more than 1 year, how do you recognize revenue? So for that mindset, this particular standard comes into the picture. Okay, so this is the background of why AS7 has come into existence. So now, first when it comes to construction contract, who are the parties to the contract we have? The parties will be one, contractor, second, contractee. So who is a contractor? Contractor is that party who is going to construct a property. Who is the contractee? For whom it is constructed. So for example, we approach one person and ask that person to construct a property for us. So for us, we are going to get a building. That person is going to construct the building. Who will pay money to whom? We will pay money to that person who is going to construct. The one who is going to construct, we call them as contractor. The one who is taking the benefit of that particular construction is the contractee. Now, point to be understood, AS7 coverage is only applicable for contractor, because over here we are learning about revenue segments and also basically for whom it is revenue, for whom it is a business, for whom it is sales, for contractor it is revenue. So therefore AS7 is applicable only for contractor. For contractee you can say AS10 might be applicable or say AS2 might be applicable. Suppose if they use that structure as a fixed asset or property, plant and equipment, AS10 will come. If they use it as inventory, AS2 will come. So for contractee, other standards are supposed to come. This particular standard is applicable for contractor. Now let's start discussing about how contractor is supposed to consider this AS7 perspective or AS7 requirements. So starting with types of contract. Whenever there are construction contract, mainly there are two types of contract. One is called as fixed price contract and second one is called as cost plus contract. Now, what do you mean by fixed price contract? Contract price remains fixed when at the time of agreement. Okay, so basically contractor and contractee sit together, they negotiate, they are going to sign the agreement. At the time of signing the agreement itself, they will decide the price. So price doesn't mean that lump sum amount will be decided. It could be decided according to per unit also. So price decision does not only mean a lump sum of say 50 lakh, 1 crore or anything like that. It could be anything. Either you go for a lump sum structuring or you can go for per unit structuring. But a price is fixed. We call them as fixed price contract. Since the price is fixed, in future, if there are any overshooting of cost and all, sometimes it's possible. When we are signing the contract, there was no market problems. Once we signed it, market problems started. So at that time, contractor will have a loss because he went into pricing based on the old estimates. Now the estimates are getting changed. So for that reason, normally in fixed price contract, they will have something called as escalation clause, whereby if at all price escalates, if price changes at that time in the contract or according to the contract, contractor might charge some extra cost to contractee. So that is how escalation clause is supposed to come into picture. Now, what do we mean by cost plus contract? Cost plus contract basically means cost will be reimbursed by the contractee plus a fixed margin will be paid. So the point with cost plus contract is price is not fixed. There is no price which is fixed. What happens in cost plus contract? Every time contractor is going to incur cost, he will approach the contractee, collect money. So every expense incurred will be reimbursed. If that is the only thing going to happen, it feels like contractor worked for free. So for that, what he does, he collects an extra margin as profit. So extra whatever is collected is for contractor. Apart from that, everything else will be only price payments or only cost payments. So that's how there are two types of contracts involved. Now, accordingly, how do we recognize revenue then? So when it comes to AS7, where we talk about entire stuff on construction contract, one of the major issue lying is with this point as to how do you recognize revenue. Now for that, AS said recognize revenue according to progress work done. See, the point is I can give you a simple example. Say 100 rupees is the total price of the contract. Okay, 100, I will just take a simple number. 100 rupees is the total price of the contract. Assume that the contract is for 3 years. Okay, now if you go with the mindset that let me recognize revenue at the end of contract, this entire 100 will be recognized in third year only. Now at that time, what happens? First 2 years, there won't be any revenue. Suddenly at third year, there is a total revenue. So instead of that, to go on a specific basis, to go on a proportionate basis, they say according to progress work done, record the revenue. Now, accordingly, what we call this? We call this as percentage completion method. So basically, according to the percentage completed, you recognize the revenue. Okay. How do you decide percentage completed? According to progress work done. On the contract, what is the progress work which is taken place? That will be considered for percentage completion. Now, how do you consider how much progress has happened? For that, we call it as stage of completion. The progress work done will be decided according to stage of completion. Okay. Now, this will be considered for the purpose of percentage completion method. So now let's quickly summarize this. What are we going to do? How do we recognize revenue? For that, apply percentage completion method. What does percentage completion method tell us? Percentage completion method tells us that according to work done, progress work done, calculate the revenue. How do you decide progress work done? According to stage of completion. So what does stage of completion tell you? Stage of completion will tell you the percentage completed. So when you calculate the stage of completion, it tells of the total 100% project, how much percent is complete right now or till now. So that is said in stage of completion. So according to the stage of completion, you are going to calculate the revenue. Now, how do you get the stage of completion? Normally, there are three methods. The first method is called as physical completion. Normally not followed because it's not that scientific. Okay, physical completion basically means of the total physical element which is decided on the contract, how much is complete. Example, 5-story building, 3 is complete, 3 by 5. Okay, therefore I said it's not that scientific because that 5-story building might have different specification. So one might be very simple, one might be very complicated. Now just by physical completion, if you say this much stage is complete, it doesn't look good. So normally it's not followed up. The second one is called as survey method. Now in this what happens, you call a professional and you ask that professional to come and check the project. That professional is going to give his advice. He is going to give his final say on it. That will be called as survey method. The third one is called as cost to cost method. Second one might be followed, but normally third method is followed. Even from the exam angle also, normally this third method is followed. Now what does third method say? Third method say about cost to cost. It tells of the total cost of the project, how much cost have you incurred, because you won't incur cost just like that. You will incur cost just to make sure that your project is complete. So for that reason, whatever is the total projected cost you have, of this how much is complete, that is said under cost to cost method. Okay, so normally from the exam third one is followed. Okay, so this is how your revenue recognition is going to take place. Certain formula is there as to how to calculate them and all. I will tell you a bit later. So basically, it depends upon progress work. Progress work depends upon stage of completion. Stage of completion will tell you the percentage completed, and that will be done according to these three methods. Now, a question comes whether percentage completion method application, is it practical all the time? Okay, see, the point is very simple. In percentage completion method, what is happening? Basically, progress work done, recognize revenue and all these stuff. So everything is done on an estimated basis. It's not actual, correct? So whenever it comes to this particular point of percentage completion method, everything is done on an estimation basis. And you're applying estimation on what? You're applying estimation for a revenue element. Now, whenever revenue element is considered, you can estimate. I'm not saying you shouldn't estimate, but when you do it, it has to be properly done because it is revenue. You are not supposed to overshoot revenue. Simply recognizing revenue will never be allowed because it is going against prudence. So therefore, whenever it comes to percentage completion, how to make sure that this method, when it is applicable, it is applied whenever this requirement is properly followed. Now, what is that requirement? There has to be reasonable estimate of final outcome. Reasonable estimate of final outcome. Okay, so basically, if there is reasonable estimate of final outcome, then apply percentage completion method. Okay, so basically to apply this percentage completion method, there has to be reasonable estimate of final outcome. Now, what do we mean by reasonable estimate of final outcome? We will see that later. If it is there, then apply percentage completion method. A question comes, no, it's not there, sir. What should I do? There is no reasonable estimate of final outcome. Then what can be done? For that, they say whenever there is no reasonable estimate of final outcome, two consequences. One, when it comes to revenue, recognize to the extent of cost incurred which is recoverable. So whatever costs which are recoverable, that cost will be treated as revenue. That's it. You will not go for the extra profit margin, nothing doing, because there is no reasonable estimate of final outcome. You are not able to get your final say on it. So therefore, whatever costs are incurred, which could be recovered through the contractee, that is your revenue. When it comes to cost, whatever it is incurred will be considered as cost. So basically what is going to happen in the second case, when there is no reasonable estimate of final outcome, either your profit will be zero or there will be a loss. Why? Because you will directly recognize the entire revenue max to the extent of cost incurred or less than that. So therefore, whatever cost is incurred, if you recognize to the 100% extent also, profit will be zero. If you recognize it lesser, there will be a loss. Why? Because there is no reasonable estimate of final outcome. As soon as you get the reasonable estimate, come back to percentage completion method. It's not like one time it is no, it is permanently no. It's not like that. So once you get the reasonable estimate, come back. Come back to percentage completion method, calculate it normally, apply the stage of completion, get your answers. But till then, you have to apply it according to cost incurred for revenue, which is to the extent recoverable. Other, when it comes to the expense part, it is cost incurred. Okay, so this is how it is supposed to be done. Now a question comes, how do I or when do we establish reasonable estimate of final outcome? Now this reasonable estimate of final outcome, it depends upon which type of contract it is. First, if it is fixed price contract, when can I say that there is a reasonable estimate? Number one, contract price is determinable. Then there is future economic benefit. Whatever costs you have incurred, whatever is going to happen, which means contractee is also in a right position. There is future economic benefit from this particular contract. Third, cost and stage of completion can be reliably measured. Then fourth, costs are identifiable. Okay, so if these four conditions are satisfied, then you can say that there is a reasonable estimate of final outcome. So one, price is properly fixed. So both of the parties know what is the price. Second, there is future economic benefit, which means because you are constructing this, contractee will get benefit and he will pay you the money. So therefore, there is a future economic benefit to the contractor. Third, the cost and stage of completion can be properly estimated. Okay, so whatever cost is incurred, what cost might be incurred, because that is their business, they should know how much cost might be incurred and all. So therefore it is reliably estimated. Four, costs are identifiable. Can identify what is the current cost, what could be the future cost of the total projected cost, how much cost is properly incurred, etc, etc. So if these things you can follow up, then you can say there is a reasonable estimate. Now if at all I follow cost plus contract, if I follow cost plus contract, only two conditions are enough. One is future economic benefit should flow to the enterprise. Second one, cost cost is measured and identifiable. Because when it comes to cost plus contract, there is no contract price which is fixed, so no need. Then therefore only future economic benefit should come into the picture, and stage of completion as such is not needed for cost plus contract, because it just depends upon reimbursement of the cost, at the same time marginal also. But cost should be properly measured, because that is the one which is the key when it comes to cost plus contract. So this is how, as soon as you get the reasonable estimate, apply percentage completion method and start getting your elements. Now, when you are doing these cases, So in both situations, when there is a reasonable estimate, when there is no reasonable estimate, etc., when you are doing this particular job, what happens is, in those situations, if at all total contract price falls short compared to total contract cost, okay, so basically in any situation, if total contract price is less than total contract cost, you can say ulta also, total contract cost is more than total contract price, this will be leading to a loss to us, isn't it? Because this is basically a loss for us, and this loss will be called as expected loss. Now see, as I've already told you, when it comes to revenue recognition, there is already a huge problem. What is that? You are anticipating revenue. You are anticipating revenue. First of all, it's a controversial one. But yes, standard allowed because this particular contract itself is like that. There is no other choice. But the point is, this standard has to be very prudent because it is related to revenue, and that too anticipated one. So therefore, they said in any situation, if you find that cost is shooting over the revenue, because contractor cannot stop the contract just because you find that the cost is more, because whenever a contract is entered, it's a binding agreement, you cannot just come out of it. So therefore he has to perform, and there he has to perform under a loss, and that loss, what does it tell? It tells that you should immediately recognize it. Basically you should immediately recognize, you are not supposed to wait for anything. So as soon as you find that, as soon as a contractor finds that there is an expected loss, immediately recognize. Now a question comes, does any bahana chalega? No, no bahana is going to apply. It tells this immediate recognition of expected loss will be done irrespective of stage of completion. No matter what is your stage, doesn't matter, you have to recognize. Second, start of contract. So I haven't even started, but still nothing doing, you have to recognize it. Third, there is profits from other contracts. There are profits from other contracts, so therefore let me not recognize this loss. No, you have to recognize it irrespective of anything. So whenever you find that there is total contract cost more than total contract revenue, it will be called as expected loss. Foreseeable loss can also be called. That expected loss should be immediately recognized in the books irrespective of the time. It could be any time, you have to recognize it in the books of account. So that is how they have said us about how do we deal with the expected loss mechanism. Okay. Now, so this is about the revenue cost element which we have to consider whenever you apply AS7. Now, certain important formula I want to tell you. First, how do we get percentage completion? Okay, how do we get percentage completion? Normally, as I have told you, cost to cost method is followed. Survey method percentage completion you need not calculate. The professional themselves are going to tell you. But if you want to calculate, it will be done according to cost method. Now, so percentage completion, cost incurred till date divided by total cost into 100. So cost incurred till date divided by total cost. How do you get total cost? Cost incurred till date plus future cost. That will be my total cost into 100. So whatever you get will be a percentage completion. But try to understand this. I will highlight it now. They say what? Cost incurred till date divided by total cost, which means even percentage completion will also be till date then. Now, Why am I saying this? Very simple. I started my contract on year 1 and the total term is 3 years. So if you are in year 2, if you calculate percentage completion, cost incurred till date means from year 1 till date. So 2-year cost incurred till date will come into here. So therefore even percentage completion is also till date. So starting date till year 2, how much percentage is completed? So therefore, how will that impact? It will impact revenue for the year. So revenue for the year is equal to contract price into percentage completion minus revenue already recognized. See, this is where the impact lies, whereby from year 1 till date, how much percentage is completed. So that what happens at that time? Say 1000 crore is the total contract price. 1000 crore into say 60% is contract completed till date. So therefore 600 crore will be recognized. That is what? That is revenue till date. If I want current year revenue, revenue till date minus previous revenues. So therefore it is written as minus revenue already recognized. Okay, so that's how it is supposed to be taken up. Later, if you want profit or loss, it's going to be revenue for the year minus cost incurred for the year. Revenue for the year minus cost incurred for the year. So this is how you are going to get your formulae altogether. Normally profit calculations are and all are very common. So first you have to get your revenue, that is important. Cost incurred till date, anyhow they will be given it to you, so that you can just look into it. Finally revenue minus cost will give you profit. So this is how you have to bring up your answers when it comes to AS7. Now apart from this, apart from whatever calculations we have done, so now we saw certain terms and it would be better if you know what are the inclusions in those terms. What are they? Number one, what do I mean by contract price? We have told na, when it comes to fixed price contract, contract price is fixed. Revenue for the year, how do you calculate? Contract price into percentage completion. So what are the contract price involved? So contract price is basically the price at which contract is entered into. What are the inclusions when it comes to contract price? First, initial agreement. So according to initial agreement, whatever price is fixed, that will be included in contract price. Second, if there are any variations. So initially you entered into agreement, the work got started, but later there was some variations in the contract. So at that time price will fluctuate. So that variations will be considered. Third, if there is any escalation clause, as I've already told you, in fixed price contract, there is a chance that contractor might include an escalation clause. If he includes it, he will increase the price of the contract. So that will be considered. Fourth, if there are any incentives. Say for example, initially it is decided that the contract will be finished within 4 years. But contractee is in a hurry. So contractee asked, can you finish it 6 months before? Contractor will say, I can finish it provided I will increase the price by some say 50 lakh or something. The contractee said, okay, there is an incentive now. So if there is an incentive, even that can be included, provided for these three variations, escalation as well as incentives. First, there has to be certainty in collection. So whenever you have got these, there has to be certainty in collection and there has to be agreement with the both parties. only contractor directly just cannot come up and say, we will put an escalation clause, let me increase the price. No, contractee should also agree. There has to be a proper agreement, otherwise contract doesn't come into the picture. Then there has to be certainty. Now the point is, say there is incentive. Incentive says that if you finish before 6 months, you are going to get extra value. Correct. You have to make sure that you can finish it. If it is highly impractical that you are not able to finish, but I still want to recognize incentive, no, that is not possible. So for that, certainty is important. So certainty is also covered over there. So certainty in the work, certainty in the collection, everything will be covered in that particular point. So this is your contract price. What do we mean by contract cost? Now, this contract cost will first incur or will first include specific cost. Specific cost on the contract. Example, material, labor, overhead. If there is a professional who is going to work only for my contract or only for that project, so n number of stuff which is directly related to that particular contract. Even though I am a contractor and I have hundreds of contracts, only that contract it is applicable. Second one, attributable cost. In this, what happens? Total is there. That particular cost is incurred for everybody, even for my contract. So all contracts it is done, even for my contract also it is done. Example, say some things like machineries, depreciation. So machinery, when they are used, it is used for my project also, it is used for the others project also, and it goes on. So at that time, what happens? For my project, what is attributable? Only that has to be considered over here. Then third one, contractee specific cost. Now this will be included in the agreement. The contractee asks for a specific cost to be incurred, in the sense he wants certain specifications in the contract. At that time, contractee says, yes, I'm okay with it, I will be ready to bear that particular cost, then no problem. So according to contractee requirement, you make the changes, you will consider that as cost from your hand, which obviously might be reimbursed by the contractee. Okay, with these contract costs which are included, there are certain exclusions also. From the contract cost, there are certain exclusions. What are they? First, general admin cost, because it's not related to contract. So general admin costs are excluded. Next, selling costs are excluded, because obviously again not related to the contract. Third, if there is any R&D, it is excluded. So why R&D is excluded? Because it's not related to a particular contract. You make your R&Ds, that will be applied for all the similar contracts which is going to come from today till life, until and unless you change your R&D. So since it is something which is incurred on an overall basis, it's not considered for contract cost. Finally, if there are any idle fixed asset, depreciation of these idle fixed asset is not contract cost. Example, machinery is supposed to be used. Say contract 1 you used for 50 days, contract 2 you used for 200 days, contract 3 you used for 60 days. So 60, 200, 60. So there are 3 projects, 1, 2, 3, 60 days, 200 days and 60 days you used. How much is the total? Total is 320, which means what? 45 days it was idle. Now when you apply depreciation, apply only 60 by 365, 200 by 365 and 60 by 365. Okay. Now you may ask, sir, what should I do with this 45? 45 days which are idle, that should be directly transferred to P&L, because that is not a part of contract cost. So you are not supposed to ask this with your contractee and ask for a reimbursement, because you kept it idle. What can he do? So therefore, that is not included in contract cost. Okay. Finally, when it comes to this standard now, the last part of the standard is what are the disclosure which could be done. Now, the reason I'm telling you this is because sometimes they can ask a question directly on this as to what are the disclosure, in the sense from the calculation point of view also, they will directly say calculate all such amounts which should be disclosed. So these disclosures are supposed to come. Number one, revenue. Revenue is supposed to get disclosed. Okay. Now, what element of revenue should come first? Amount of revenue you need to disclose. Second, you have to tell the stage of completion method. So which method you chose for the stage of completion angle, method of recognizing revenue, method of recognizing revenue. Okay, so these are the three stuff which I have to consider from revenue. Amount wise will be the first one. Okay, number wise the first one. Then second thing, you have to disclose the cost and profit or loss. Okay, what are the cost incurred and what are the profit or loss which is supposed to be taken up. The third, you have to tell about retentions. How to tell about retentions. Now, what do you mean by the term retentions? Retentions basically means billed but not collected. Okay, maybe due to certain conditions, maybe any reason, but billed but not collected, you call them as retentions. Then fourth one, progress billing. Progress billing. Now this basically means how much is billed till date. So how much is the contract which is billed to the contractee and how much is supposed to get collected from them. That is progress billing. Then fifth one, you have to tell any advances collected. You haven't asked for the money but contractee has given it to you. So advances collected from the contractee. Then last one, amount due from or due to contractee. Amount due from or due to contractee. Now, when it comes to the other terms, revenue you should calculate, which you have already seen. Cost, we know. P&L, we can calculate. Revenue minus cost. Then these things like retention, progress billing and all, this is specifically should be given in the question. It should tell how much is the progress billing, how much is the retention made and all these things. This they have to tell you. But what about amount due from or due to customer? That normally you have to calculate. Okay, how do you calculate them? Basically, the calculation is revenue plus profits minus loss. So any of the two. If profit is there, add it to revenue. If loss is there, deduct it from loss minus progress billing. If you have already billed, then it's fine. You have already considered that. So basically revenue plus profit minus loss minus progress billing. Now, if at all this answer is positive, if at all the answer is positive, then I will remove the bracket symbol. If the answer is positive, then consider this as due from customer, which is contractee. If the answer is negative, then it is due to customer. Okay, so basically this is the way you have to calculate them: positive due from, negative due to. So this is how you have to consider the AS7 requirements. So these are the disclosure requirements. Sometimes they can ask a direct problem on this, saying that how much money has to be considered over here. So this is how the theoretical AS7 comes into the picture: contracts, how revenue is recognized, how cost is recognized, and accordingly the formula involved, and how that percentage completion method applicability comes into the picture. Point to be remembered, normally we forget what happens when percentage completion method cannot be applied. For that, I have already told you, revenue will be recognized to the extent of cost incurred, which is recoverable. Cost is considered to the fullest extent, which is incurred. So that is how you have to consider when percentage completion method is not applicable. If applicable, then we have seen how revenue comes into the picture and all. So this is the theory effect of AS7. Now let's quickly move towards one or two problems and can conclude this particular standard. Okay, I'll quickly read up the question now. Uday Constructions undertake to construct a bridge for the government of Uttar Pradesh. The construction commenced during the financial year ending 31/3/19 and is likely to be completed by the next financial year. The contract is fixed price of 12 crore with an escalation clause. You are given the following information for the year ended 31/3/19. Cost incurred up to 31/3 4 crore. Further cost estimated to complete the contract 6 crore. Escalation in cost was by 5%. Hence the contract price is also increased by 5%. You are required to ascertain the stage of completion and compute the amount of revenue and profit to be recognized for the year as per AS7. Okay, so simple question if these kind of things are asked, but yes, you have to use your mind properly here. See, first thing, the price is 12 crore with an escalation clause, which means contractee has agreed for an escalation clause. If it is there, then contractee has to reimburse. Then after that, cost incurred till 31/3/19 is given. Then further cost estimated to complete. Okay, and this escalation was by 5%, which means this escalation is already included in the further cost. So in the further cost, they have already considered it and they found that there is an escalation by 5%. Therefore, price is also escalated by 5%. Okay, then they have asked you to calculate the revenue, the stage of completion, etc. As I am telling you, survey method and all, if it is there, they have to specifically tell you the percentage. Here, not done. So basically, we have to apply cost to cost method. How do we apply the formula and all? I will just write it for you. Later, I will show you the solution what institute has given. So what is the formula? It is cost incurred till date divided by estimated total cost. Now, the point is cost incurred till date. Yes, it is given 4 crore. Estimated total cost again given. Estimated total cost is not directly given. How can I calculate? Incurred till date but plus further cost. Incurred till date plus further cost will give me the total cost. So 4 plus 6. Correct? So 4 is already incurred. 6 further will be incurred. So total is 10. So how much is over then? 4 by 10 will give you 40%. Cost incurred till date divided by total cost into 100. So 4 divided by 10 into 100 will give you 40%. That is your percentage completion. This percentage completion is applied on what? It is applied on contract price to get the contract revenue for the year. So 12 crore is the contract price, but 5% escalation can happen. So plus 5%. Okay, so because of that, what happens? 12 plus 5% will give us 12.6. Okay, 12.6 into 40% will give you revenue for the year. So 12.6 into 40% is 5.04. 5.04 is our revenue to be recognized for the year. Minus cost for the year is how much? 4 crore. So automatically 1.04 crore is the profit to be recognized. Simple. So first what did we do? Cost incurred till date divided by estimated total cost, where we got 40% as stage of completion. 40% is applied on price, but price is after escalation clause. So 12 plus 5%. So therefore on that 12.6 you applied 40%, you got 5.04 minus cost incurred till date will give you profit. Now look into the solution. Total cost is 10, contract price is 12.6, so 40% is 4 by 10. Then we got 5.04 as contract price or contract revenue for the year, which is 12.6 into 40%, 1.04 crore is going to be your profit. Okay, simple. You have to just think about how the whole thing could be done. Now let's go towards another question. This question is given in RTP. Okay, this is an RTP question. Then this one is MTP. Once you read them, you will understand it really well. Okay, so Akar Limited signed on 1/4/19 a construction contract for 1 crore 50 lakh. Following particulars are extracted in respect of the contract for the period ending 31/3/20. materials used, labor charges paid, higher charges of plant, other contract cost incurred, labor charges 2 lakh are still outstanding on 31/3/20. It is estimated that by spending further 33 lakh 50,000, the work can be completed in all respect. We are required to compute profit or loss for the year to be taken to P&L account and additional provision for foreseeable loss to be recognized as per AS7. Okay. Now, again a question is given to you and accordingly we have to calculate profit for the year. How do you get it? Revenue minus cost. So for revenue, what should I want? We want percentage completion. How do you get percentage completion? Cost incurred till date divided by estimated total cost. Now, look into this. Only one point I want to be more specific about. Only one point I want to be more specific about, which is labor charges is paid and labor charges are still outstanding. So therefore, when it comes to the labor charges mechanism, you have to add both. Okay, both of them will be added to get your answer. So you just have to add everything to get the cost incurred till date. Just have to add everything. It is already done here. I will consider that itself, which is 1 crore 34 lakh. It is addition of all these elements. Then they said 33 lakh 50,000 further cost. If you add, you are going to get your contract done. So that will be added. You get 1 crore 67 lakh 50,000 as the total contract cost. So if you do 1 crore 34 lakh divided by 1 crore 67 lakh 50, you will get the stage of completion 80%. Apply 80% on 1 crore 50 lakh. Apply 80% on 1 crore 50 lakh to get the revenue for the year. So if you apply 1 crore 50 lakh into 80%, you will get 1 crore 20 lakh. If you apply 1 crore 50 lakh into 80%, you will get 1 crore 20 lakh. Compare cost incurred till date here. 1 crore 34 lakh, which means 1 crore 20 lakh minus 1 crore 34 lakh. 14 lakh will be your loss for the year. I hope everybody are following. So 1 crore 50 lakh into 80% will give us 1 crore 20 lakh. Incurred till date is 1 crore 34 lakh. Take the difference. Cost is more. So there is a 14 lakh loss. Not just this. If you now see, total contract price is 1 crore 50 lakh. Estimated total cost is 1 crore 67 lakh 50. Do we remember something? We saw that if at all there is expected loss, whereby whenever total contract cost is more than total contract price, that will be called as expected loss. How much is the expected loss here? 1 crore 67 lakh 50 minus 1 crore 50 lakh. How much overshooted? 17 lakh 50,000. So what is that is the entire loss for the life of the contract. So entire loss of life of the contract is 17 lakh 50,000. That much total loss you may incur. Of this, how much is already recognized? 14 lakh, as we have already discussed here. 17 lakh 50 is total loss for the life. Of that, 14 lakh is already considered for the year. So what is that future foreseeable loss I have to recognize? The difference. The reason I am telling you is, check the question. What did they ask? Profit or loss for the year. Now that is 14 lakh. Then additional provision for foreseeable loss. So total foreseeable loss is how much? 17 lakh 50, of which 14 lakh is already recognized. 3 lakh 50 is foreseeable loss to be provided. So that is how you have to consider the problems based on AS7. So it is easy. You can get this easily, but you have to use certain level of understanding. Once you get that, this is again numbering accounting standard, which is good for you because you can properly calculate the problem. But remember these rules which we have discussed when it comes to the standard. So with this, we will finish AS7. We will conclude this AS7. Now let's move on. So what does AS16 tell us? AS16 is going to tell us about borrowing cost. So AS16 is going to tell us about how borrowing cost recognition in a particular scenario is supposed to happen. Now, majorly, what are you going to learn in this accounting standard? It is going to tell us about how treatment of borrowing cost should take place. So, it is going to tell us about treatment of borrowing cost. Now, what type of treatment is possible when it comes to borrowing costs? So, either borrowing costs are allowed to be capitalized, or borrowing costs are treated as revenue. Now, what do you mean by borrowing cost getting capitalized? Borrowing cost getting capitalized means it is added to cost of asset. So, whatever asset you have, borrowing costs are allowed to be added to such asset. If at all it is going to come under capitalization. If it is revenue, then it will be treated as expense, and this expense will be transferred to P&L account. Okay, so basically the ultimate requirement of this standard is it keeps on telling what all borrowing costs are allowed to be capitalized. If they are allowed to be capitalized, you will transfer that to asset account. If at all it is allowed to be considered as revenue, it's an expense which is transferred to P&L account. Okay, now a question comes, what do we actually mean by borrowing costs? So basically, these are interest and other costs incurred in connection to borrowings. Incurred in connection to borrowings. So interest and other costs. So whatever costs are incurred at the time of borrowings, whatever costs are incurred because there is a borrowings, all these things are borrowing cost. Okay, so for this particular reason, there are certain inclusions when it comes to borrowing cost. So borrowing cost, we have to talk something about inclusions of it. What are the inclusions? Number one, interest and commitment charges. Interest and commitment charges. This is one inclusion when it comes to borrowing cost. As discussed, one of the major costs incurred for borrowing is interest. We issue debenture, borrowing, we have to pay interest. We take a loan, borrowing, we have to pay interest. So interest is the major borrowing cost what you have. Then second one, amortization of discount or premium on borrowings. Amortization of discount or premium on borrowings. So majorly you can now think about debenture. Debenture is issued at a discount, it's a loss, and that loss will be amortized, borrowing cost. A debenture is redeemed at a premium, again it's a loss, that loss will be again considered on a proportionate basis, amortized, again borrowing cost, because these are costs in connection to borrowings, which is debenture. Then third one, amortization of ancillary cost. If there are any amortization in connection to ancillary cost, ancillary are cost in connection to borrowings. Say something like processing charges and all these things are ancillary cost to borrowings. So those costs, if it is incurred, it will be amortized. That is also a part of borrowing cost. Then fourth one, finance charges under finance lease. This I will not explain that much in detail because it's a part of second group standard AS 19, which talks about all these leases and all. So if at all there is a finance charge, then basically or finance lease, then basically the expenditure incurred, so the lease rentals or whatever it is, are merged together and you call that as finance charge. So finance charge under finance lease will be a borrowing cost. Last but not the least, ERD can also be treated as borrowing cost. ERD is exchange rate difference, which was calculated in AS 11, whereby fluctuation of foreign currency rates, if you restate it according to closing rate, there is an exchange rate difference. So that is also could be considered as borrowing cost, but for this there are certain conditions and situations which you have to understand. I will tell this at the end of the discussion. Next, once we know the inclusions, we have to know certain exclusions also when it comes to borrowing cost. Now, what are those exclusions? Exclusions are cost of preferentiates, because they are not borrowings as such, they are considered as capital element. So, cost of preferentiates are dividend, they are excluded. Then, cost of equity, again in connection to ownership, so therefore it is not supposed to come. Then cost of retained earnings. All these things are mainly covered in cost of capital of your FM topic. So over there you talk about cost of preference, cost of debt, cost of equity, cost of retained earnings, then weighted average cost of capital. Here for AS 16 purpose, only cost of debt comes into the picture. Other elements are excluded from the discussion of borrowing cost. Now, once we know about the elements of borrowing cost, so these are the borrowing cost which is going to come into the picture. The next part is, as I have already told you, that the major impact of this standard is to tell whether it can be capitalized or whether it should be transferred to revenue. So for that, capitalization comes into effect. When capitalization of borrowing cost is allowed, for that we say capitalization is allowed if asset involved is a qualifying asset or not a qualifying asset. I will write it as QA. Now the point is, only if the asset is qualifying asset, capitalization comes into the picture. Not all borrowing costs are allowed to be capitalized. Yes, I incurred interest, I will add interest to asset. No. Only if that asset is a qualifying asset, then only it will be allowed for addition purpose. So if at all it is not a qualifying asset, it is revenue. Now what do we know about revenue? It will go to P&L account. What do we know about capitalization? Add it to asset. So now we have to learn one other stuff. What is that? What do we mean by qualifying asset then? So only if it's a qualifying asset, it is allowed for addition purpose. So what do we mean by a qualifying asset? For that, asset that takes substantial period of time to get self ready for its intended use or sale. So qualifying assets are those assets which take substantial period of time to get itself ready for its intended use or sale. Okay, so breaking up the definition, two major point comes. What are they? One, substantial period of time. Two, get itself ready for its intended use or sale. So if that is the situation coming into the picture, you call that as a qualifying asset. Now, first on the right hand side, to get itself ready for its intended use or sale. It means what? Asset is getting ready for its intended use, means what? It's a fixed asset. because you will use that asset for the purpose of production. On the other way around, intended use or sale, if the asset is directly sold in the market, it is inventory, which means qualifying asset can be both fixed asset as well as inventory. It's not like only fixed asset should be qualifying asset. Qualifying asset can be both fixed asset as well as inventory. So if you remember, exclusion of cost in both AS2 and AS10, when we discussed, we spoke about interest. Over there we said interest is generally excluded until AS16 allows it. So therefore, both in AS10 and AS2, which is fixed asset as well as inventory, the impact is going to come. Major thing is, for both of them, substantial period of time should be considered. So now a question comes, what do we mean by substantial period of time? The normal substantial period of time, we take it up as 1 year or 12 months. Then a higher or a lower period is justified. Higher or a lower period can be considered as qualifying asset if justified. And finally, it is done on case to case basis. It's not like for all the cases the rules are the same. It depends upon that case. Example, normally it takes 1.5 years to construct a particular asset, but our contractor took only 9 months to construct that same asset because we were in a hurry. Now, at this time, even though the time taken is less than 1 year, you can justify saying that it's a qualifying asset, and it is always done on case to case basis. Okay, so you have to make a case to case analysis. They said normally it is 1 year, but a higher and a lower period is properly allowed if at all it could be properly justified. So what are those examples we can take up then? Some of the examples are construction of building, then construction of plant, etc. So it has to take substantial period of time to get itself ready. Even from the inventory angle, manufacturing of plants might take time. This large machinery manufacturing might take substantial time. Again, at that time also it becomes a qualifying asset. So that is how you have to deal with it. A qualifying asset allowed to be capitalized. If it is not a qualifying asset, it is expense transferred to P&L. Now, when it comes to the borrowing cost then, so I hope everybody understood how capitalization will come into the picture. Now, when we talk about borrowing cost will have its system. Borrowing cost will have its life. It goes on a particular stage to stage basis. Now, what are those stages which will apply in borrowing cost? One is commencement of capitalization. So you saw that the asset is a qualifying asset. If the asset is a qualifying asset, you are allowed to capitalize borrowing cost. But when do you start it? Commencement. You have to give a start to the capitalization. You cannot directly just do it. For that, rules has been given by the standard. What are those rules? Number one, expenditure on qualifying asset is incurred. Okay, so qualifying asset work or expenditure on the qualifying asset has started, which means the work has started. Second one, borrowing cost is incurred. So only taking the loan, interest is coming up, but you haven't even put a single expenditure on your building. Say for example, I will consider building construction. Okay, loan has been taken, but no expenditure has been incurred on the building. It means what? You have taken loan, but the work has not started. Don't capitalize. Now, borrowing cost has been taken, but the interest is yet to be incurred. Then again, don't capitalize it. The third one, activity on construction of qualifying asset is in progress. So that particular activity, work on the qualifying asset is ongoing. So first, expenditure has been incurred on the qualifying asset. Second, borrowing cost is incurred. Third, work on the qualifying asset is ongoing. Now, the reason why this comes is just to show the capitalization requirement, what an enterprise can do. It will only just give some initial expenditure and ask them to start. After a week, they stop the work. Some reasons they will quote and they will stop the work. But what are they showing on papers? On papers, they are showing that the work has started. So therefore, let me allow to capitalize. No. For that, the standard said the work should be ongoing. It should be taking place. The work to create the qualifying asset for its intended use or sale should be ongoing. Otherwise, no, it is not supposed to be considered for capitalization purpose. Now you may say, sir, we started, but in between I can stop it. Na? I started for 6 months. Expenditure is incurred, borrowing cost is incurred, activity is also ongoing, but I did it for 6 months. After 6 months, I stopped it. Then later, after 3 years or something, again I'm going to start. So on papers, I have started the work. Activity was ongoing. Later, I stopped it. Let me allow it to be capitalized. No. For that, they said if there is an interruption in activities. This is the middle stage of the borrowing cost. So you started, you put the activities, you put the expenditure, borrowing cost is incurred, they allowed you to commence the capitalization. But in between, you are interrupting the work. If you are interrupting the activities on qualifying asset, then capitalization is suspended. What? Entire amount is suspended? No. Capitalization is suspended for period of interruption. So basically, for the period of interruption, you are not allowed to capitalize your borrowing cost. For example, January 2020, all the commencement related conditions were satisfied. So because of that, we are supposed to start our borrowing cost capitalization. Assume that from July 2020 to December 2020, the work got stopped. There was an interruption to work. Later, January 2021, the work resumed. Okay, so Jan 2020 it started, then the work got interrupted. January 2021 onwards, it continued, which means from January 2020 to July 2020, it's allowed to be capitalized. Why? Commencement rules have been followed. But July 2020 to December 2020, the work got interrupted. There is no work, which means over here, borrowing cost capitalization is suspended. So for this time, the interest is transferred to P&L. Okay, so there was an interruption. So therefore, capitalization is suspended for that period of time. Transfer the interest, transfer the borrowing cost to P&L. Again, January 2021 onwards, work resumed, capitalization continues now. Again, now interest is allowed to be added to the asset. So for the period of interruption, you are not supposed to capitalize. Again, a question comes whether this is applicable for all the times. No, there are certain exceptions to the rule. What are the exceptions to the rule? Number one, interruption due to technical and admin work. say approvals are supposed to be taken up, the government officials wants to check all these things. For those time you stopped it, because without their approval it cannot be continued. So all these technical and administrative work are getting carried out, which is inevitable. At that time, if at all there is any interruption, then no problem, it will not be considered as suspension. The exception basically means there is no suspension. Even though there is interruption, suspension is not allowed for capitalization purpose. It still continues. So if there is no suspension, capitalization is ongoing. This is number one. Second one, interruption due to unavoidable reasons. Interruption due to unavoidable reasons, which means there are unavoidable reasons whereby you have to suspend the work. There is no choice. Example, one of the very famous example is this. Say you are involved in constructing a bridge. Now, on one fine day, there were huge floods for that particular place. Now, what happens? You have to stop capitalizing. Sorry, you have to stop your work. Because there are floods, you cannot ask your workers to go put a raincoat and just go and start working. No, it's not possible. So because of that, what happened? The work got suspended. Was it because of avoidable reasons? No, it's an unavoidable reason, which means it will be allowed for capitalization purpose. Okay, for example, whenever a huge buildings are getting constructed, there is time for curing of the building. So curing itself might take like 1 to 2 months, just like that. So at that time, curing is an integral part of construction. Even though work is suspended, it is utilized for curing purpose. Again, unavoidable reason. At that time, the suspension does not take place. So if there are unavoidable reasons, do not consider them for suspension. So you started borrowing cost. In between, if there is an interruption may not be there all the time, but if there is an interruption, then you can suspend them. But exception to the rule, if you are into admin work or if it is an unavoidable reason, no suspension take place, it still continues with capitalization. Ultimately, once it is done, once all the situations are over, finally it goes with cessation of capitalization. When will you stop it? Cessation of capitalization. For that, we say, what do you mean by cessation? Ending. So, when are you supposed to end the capitalization? For that, we say, when the asset gets available for use according to intended use or sale. So whatever intended use or sale was there, if at all the asset comes to that level, if it is available for use, then stop capitalizing the borrowing cost. Okay, but sometimes we say, if at all there is any qualifying asset which could be completed on phased basis, step by step basis, and each step, as soon as it gets completed, you can occupy them, then cessation is done also on phased manner. For example, there is a business hub. Okay, you want to create certain 10 factories in a particular business place. So you have taken a place, in that place you want to create 10 factories. Now, all these 10 factories construction is given to one of the one of the contractor. Now the point is, if at all each factory has its own mechanism and each factory are not interdependent, then as soon as one factory is over, borrowing cost connected to that factory is over, because there is no matching bit or there is no interdependency of these factories on one another. It's totally different. So as and when each factory is complete, borrowing cost related to that factory stops into the picture. So that's how cessation of borrowing cost should happen. So commencement, suspension and cessation. Now after that, what are the types of borrowings we have? For capitalization purpose, amount wise, this is important. What are the types of borrowing we have? One, you call it as specific borrowings. Second, you call it as general borrowing. Now, what do you mean by specific borrowing? Borrowings are made only for qualifying asset. So whatever borrowings are made is only for that purpose. There is no changes on that. So specific borrowing. What about general borrowing? General borrowing means borrowings are made in general and also utilized on qualifying asset. Say for example, there is an OD balance in your hand. So there is a bank OD. Bank OD, you are using it for every purpose. You use it to pay salary, you use it to pay your supplier, you use it to pay your rent, all these things. At the same time, you use it to pay your contractor of construction of building as well. Now what is happening? You are using this particular borrowing for every general purpose. Along with that, you are using it for qualifying asset also. At that time, we call it as general borrowing. First, if at all there is specific borrowing, how do you capitalize? Is equal to actual borrowing cost incurred minus any income from temporary investment. Now, what does this mean? If at all there is a specific borrowing, then all the borrowing cost incurred on that borrowing is for qualifying asset only, which means capitalization is allowed. But sometimes what happens is, example, you applied for a 5 crore loan and you got it. Okay, you applied for a 5 crore borrowings and you got it. But contractor is in need only of 3 crore right now. He said 2 crore I will collect after 2 months. So you have a total of 5 crore in the account, but you paid contractor only to the extent of 3 crore. Other 2 crore is payable after 2 months. Now, instead of just keeping this 2 crore in current account or OD account, which doesn't fetch any returns, because current account and OD account doesn't have any interest payout from the bank. You should pay interest if at all you have taken more money. But other than that, no interest will be paid on these accounts. So instead of simply wasting it, temporary time, you put this in amount somewhere else to earn something, so that at least this extra interest cost could be saved. So for that reason, if you invest it and you get any temporary income, that has to be deducted. So total interest cost incurred minus if there is any temporary income, what you have received from this borrowings. This is specific borrowing capitalization. Now what about general borrowing? General borrowing capitalization depends upon a capitalization rate because you cannot directly understand how much amount has been utilized. If you could understand how much amount has been utilized, then total interest into utilized amount divided by total amount. Example, total loan is 10 lakh. This is a general borrowing. You utilized 3 lakh for qualifying asset. Total interest is say 50,000. Then what do you say? Capitalization is 50,000 into 3 lakh by 10 lakh. Simple. But if at all it is very difficult to trace as to how much amount is used for general purpose, how much amount is used for qualifying asset purpose, we directly apply a capitalization rate for the purpose of ascertaining borrowing cost capitalization. Now, how do you determine the capitalization rate? It's basically weighted average rate on borrowings. Weighted average rate on borrowings. Okay. So if at all there are more than one general borrowing through which the amount might have got utilized and all, you consider one weighted average rate on that borrowing. If there is only one general borrowings, at that time you can easily apportion. But if there are more than one general borrowing and you don't know from which loan you took how much money, that time you consider a weighted average rate. So since you apply a weighted average rate which is on an estimation basis, the amount which you calculate for capitalization should not exceed the actual borrowing cost. That's one disclaimer given by the standard. If it was specific about consideration, obviously it would never exceed. But if you take a general basis, if you take a capitalization rate, chances are there that the price might increase or the value might increase. So that amount should not exceed the actual borrowing cost increase. So this is how general borrowing comes into the picture. By looking into the words, maybe it's a bit difficult to recall. So for that reason, what I have done is I have solved one question on this general borrowing. So if you find that you are not able to understand the situation as well as the explanation, make sure that you watch till the end and look into that problem where I have explained you how general borrowing are supposed to be considered. Now, finally, the last part of this theory part of AS16 is about ERD. When ERD comes into the picture for the purpose of capitalization. Now, ERD comes into the picture for the purpose of capitalization if there is a foreign currency loan. Okay, a foreign currency loan has been taken, and basically, if you now remember, if at all you have seen the previous video, at that time I have explained you about AS11 and foreign currency loan. Whenever you have got a monetary item, restatement will come. Restatement, if it is there, ERD will come, and foreign currency monetary loan is a monetary item because the value is fixed and determinable. Correct? So because of that, you have to consider it accordingly. So when there is an ERD on foreign currency loan, part of it is allowed to be capitalized, part of it will be transferred to P&L. We know that normally ERD is transferred to P&L, but over here, part of it is allowed to be capitalized when there is a foreign currency loan. Part is capitalized, part should be treated or transferred to P&L. Okay, if that is the case, what will be allowed to be capitalized then? What part of ERD is allowed to be capitalized? It is allowed to the extent of similar interest if loan taken in India. Now, first logic what you have to understand is, why do you go for a foreign currency loan? Whether that loan is not available in India, it is available. Then why do you go for a foreign currency loan? Because Indian interest rate will be more than foreign interest rate. The Indian interest rate is 10%. In USA, it is allowed at 3%. Automatically, what happens to these people? These people will feel that foreign currency loan is better because only 3% is the interest rate. So, but for that reason, since you took it at 3%, chances are there that ERD will arise because ERD will obviously be there whenever you deal with foreign currencies. So one gain of reducing interest is leading to a loss of exchange rate differences. So for that reason, we said it is allowed to be capitalized considering a similar interest if the loan was taken in India. The other part of ERD will be transferred to P&L. Okay, so to the extent of borrowing cost or to the extent of amount which will arise whereby it is related to Indian interest rate is allowed to be capitalized, the other part will be taken to P&L. Now maybe you'll get confused. What is this all about? I will give you an example. Through an example, I will try to understand. But first try to remember that ERD is also a part of borrowing cost which can be capitalized. Also, interest is another part which is always allowed to be capitalized if the asset is a qualifying asset. Okay. Now let's assume that there is a foreign currency loan taken, $10,000. Interest rate is say 4%. And on the date of taking the loan, the rate was $1 is equal to 60. Okay. Now, balance sheet date, $1 is equal to 66. This is the situation. If the same loan was taken in India, the Indian interest rate let's assume that it was 10%. So if a similar loan was taken in India, it would have been charged at 10% interest rate. Okay. Now, what things are allowed to be capitalized then? So on the date of taking the loan, the exchange rate is 60. On the balance sheet date, the exchange rate is 66. The first thing which will arise is interest on foreign currency loan. This is always allowed to be capitalized, assuming that the asset is a qualifying asset. Those formalities are followed. Now, first of all, interest is always allowed to be capitalized. So, how much interest will come on this? 10,000, the actual interest incurred, $10,000 into rupees 66 into 4%. Why 66? Because interest is coming up at the end of the year. On the balance sheet date, interest becomes accrued. For that reason, $10,000 into 66 into 4%. We get 26,400, which will obviously be capitalized all the time because it is interest. Okay, then I will calculate how much is ERD here. How much is the total ERD? It will be $10,000 into 66 minus 60. $10,000 to 66 minus 60. How much do we get? 60,000 rupees. Now, whether the entire 60,000 ERD is allowed to be capitalized? No, you have to check that Indian interest rate. Okay. Now, just look into it. Suppose if interest was supposed to be paid in India, how much interest we would have paid? It would have been $10,000. If it was borrowed in India, at what rate you would have borrowed it? 60 rupees. Because on the date of taking the loan, the exchange rate is 60. So if the similar loan was taken in India, it would be taken at 60 rupee per dollar. So 10,000 into 60 into 10% is your rate of interest in India. So $10,000 into 60, 6 lakh into 10%, 60,000 again is Indian interest rate. Now try to understand. 60,000 is interest amount of India. In that is the maximum amount which is allowed to be capitalized. This is the max amount. Because the standard tells you are not supposed to capitalize anything more than similar interest taken in India. So that is the maximum amount to be capitalized. So of this, 60,000 is max amount. Of this, 26,400 is already capitalized. Because that was actual interest on foreign currency. That is already capitalized. What about the balance, which is 3,000 minus 26,400 is 33,600. This much of ERD is allowed to be capitalized. So I hope everybody are understanding it. So 60,000 first of all is basically Indian interest rate. Similar interest rate if at all it was taken up. So that is a standard sentence which tells us that to the extent of interest, it could be allowed to be capitalized in India. So to that extent, 60,000 comes into the picture. Of this 60,000, 26,400 is already capitalized because it is interest on foreign currency. The rest 33,600, even ERD is allowed to be capitalized. Now, coincidentally, even ERD amount total is 60,000 in the question, or according to the question. It's coincidence, okay? It will not be the same. Now, of this, capitalized is 33,600, which means the other 26,400 will go to P&L. Okay, so total ERD, how much you have, part of it will be capitalized, part of it will be transferred to P&L. So that is how you have to deal with ERD capitalization requirement. Okay, so basically, if you just recall it again, first, in foreign currency interest is always allowed to be capitalized. So that will be capitalized. Later, ERD you calculate. then calculate similar interest in India. Similar interest in India is the maximum amount. Of this, already some amount will be considered as interest on foreign currency capitalization. The other part of it will be ERD capitalized, which we have shown over here. So then once you get ERD capitalized, of the total ERD, part is capitalized, part is P. So that's how you have to deal with ERD requirement in a particular situation. Okay, so with this, we come to the end of theory part of borrowing cost, whereby we saw how the capitalization segment of borrowing cost should work. Some part we have taken. So we will take up two questions now. That one question is a proper case study, direct question which is asked. The second is the question on that uh, general borrowings, where I will try to explain you in simple sentences as to what are the steps to calculate general borrowing interest capitalization. Let's go to the question quickly. Yes. Vital Limited borrowed an amount of rupees 150 crore on 1/4/2019 for construction of boiler plant at 10% per annum. The plant is expected to be completed in 4 years. Since the weighted average cost of capital is 13% per annum, the accountant of Vital Limited capitalized rupees 19.5 crore for the accounting period ending on 31/3/2020. Due to surplus fund out of 150 crore, an income of 1.5 crore was earned and credited to P&L account. Comment on the above treatment of accountant with reference to relevant accounting standard. Okay. Now, if you look into the question, borrowing amount is 150 crore, 1419 for construction of boiler. Okay. Now the point is, if you could look into it, for construction of boiler, a 150 crore borrowing has been made. I can tell you that this is a specific borrowing because only for construction of boiler it has been taken up. But what are they doing? The weighted average cost of capital is 13% per annum, and the accountant has capitalized his borrowing cost as 150 crore into 13%. But actual interest rate is only 10%. But according to weighted average cost of capital, he capitalized. Okay, so because of that, what is going to happen? That is number one. Second, when it comes to this particular borrowing also, there is a 1.5 crores income which is earned because there was surplus fund with you. How do we deal with it? So if you now remember, if there is a specific borrowing, what should we consider? Actual borrowing cost incurred minus any income from temporary investment. Correct? Now, what is the actual borrowing cost incurred? Actual borrowing cost incurred is only 10%. It's not going to be 13%, 15%, etc. Weighted average cost of capital is borrowings as well as capital elements, preference, everything will come under weighted average cost of capital. So therefore, ignore weighted average cost of capital for AS 16 purpose. You should consider the actual borrowing cost incurred. How much is the actual borrowing cost incurred? It will be 150 crore into 10%. How much is that? That 15 crore. From this, deduct that temporary income of 1.5 crore. The difference amount of 13.5 crore only is allowed to be capitalized. Okay, so for those sentences has been given to you that first of all, it's a specific borrowing, only actual borrowing cost is allowed to be capitalized. If there is a income earned, it has to be deducted, and weighted average interest will come when there is a general borrowing. So when there is a general borrowing, I agree, the capitalization rate is weighted average rate, but it is weighted average rate of borrowings, not capital. Because weighted average capital is inclusive of equity element, preference element, debenture element, everything. We don't want that. We want capitalization rate of borrowings. So therefore, weighted average cost of capital is never allowed in any situation. Let it be general borrowing, let it be specific borrowing. It is not applicable. Therefore, do not consider it. That will be the way the answer is supposed to come. So initial sentences, then the way they have shown 15 crore minus 1.5 crore. That will be your answer. This is about the case study requirement. Now, if I talk about that general borrowing, this is one old question in one of the May attempt. This particular question was asked for 5 marks. It's the first question. Compulsory question asked. The very first question was this one. I'll quickly read it up. First Limited began construction of a new factory building on 1st April 2017. It obtained rupees 2 lakh as a special loan to finance the construction of the factory building on 1st April 2017 at an interest rate of 8% per annum. Further, expenditure on construction of the factory building was financed through other non-specific loans. Details of other outstanding non-specific loans were amount and rate of interest per annum. The expenditure were made on the factory building construction were as follows, and 4 dates along with amount is given. The construction of factory building was completed by 31st of March. As per the provisions of AS 16, you are required to 1. Calculate the amount of interest. Second, pass journal entry for capitalizing the cost and borrowing cost in respect of the factory building. So this is the way they have asked us a question. This is a question on both specific and general borrowing. I'll give you overall idea about the question. Number 1, they say there is a 2 lakh special loan. This is what specific borrowing. Now, what are the rules when it comes to specific borrowing? Borrowing cost incurred minus any income from temporary investment. Here there is no temporary investment, which means entire borrowing cost incurred will be capitalized. Done. After that, they gave you this detail. 3 borrowing details has been given. Now try to understand. The total cost incurred, if I add these 4 costs, 3 lakh, 5 lakh 40, 9 lakh 40 and 13 lakh. So 13 lakh is entirely financed by loans. You are not putting your own money here. The entire 13 lakh, first of all, this is what building amount which could be capitalized. Because any cost incurred, self-constructed or construction you have seen, all the cost incurred will be added to the asset. This is not according to AS 16, this is according to AS 10. We are now talking about borrowing cost capitalization. So, of this 13 lakh, I can now correlate 2 lakh as specific loan. So, of this 13 lakh, 2 lakh is of specific loan. The remaining 11 lakh is from general loan. The point is, how much amount is collected from which general loan? Because there are a total of 3 general loans. Total of the 3 general loans, 5 plus 4 is 9, 9 plus 3 is 12. 12 lakh is general loan. So at that time, 11 lakh is utilized in what proportion? We don't know. For that reason, we need a weighted average rate for the purpose of capitalization. Now I hope everybody understood. Because we don't know from which borrowing how much amount is collected, we have to apply a weighted average rate. Okay. Now, this is one thing. So how do I get the weighted average rate? Calculate interest. Total interest divided by total loan will give you weighted average rate. Okay, so amount into rate will give you interest. Take the total of interest. Total interest divided by total loan will give you weighted average rate. This is logic number 1 and I hope everybody understood. Now the second one. See, all these loans are there at the beginning of the year itself. Okay. All these loans are there at the beginning of the year itself, and even if you have utilized, if at all you had utilized the amount at the beginning of the year itself, entire interest belongs to that construction. Example, construction started on 1st April and you utilized the entire 11 lakh on 1st April itself. At that time, starting from 1st April, all the interest belongs to qualifying asset. That could be capitalized. However, here if you see, the amount is not utilized all of them at the beginning of the year. They are utilized in different timeline. Since you are utilizing them at different timeline, convert that into one timeline. Okay, the point is, say April 2017, you utilize the loan for the entire 12 months. Isn't it? because 1st April is the opening day of the year and 1st April 17 is the date of using the loan, which means you utilize the loan for the entire 12 month, which means interest of the entire 12 month will be allowed for capitalization. What about 31st of May? 31st of May, you utilized only 10 month of loan, which means even interest should also be capitalized to the extent of 10 month itself. August, September, October, November, December. So, sorry, August, September, October, November, December, Jan, Feb and March. So 8 months. This is for 3 months. So, to the extent of utilization of the loan, interest should be capitalized. So, therefore, what we do is, considering the month, we convert the loan amount according to equivalent entire year amount. In simple way, if I have to tell you that 1000 rupees is collected in between the year. So 1000 rupees collected for 6 months. Can't I say that this is similar to 500 rupee collected for the entire 12 months? Correct, na? So 1000 rupee collected for 6 months is as same as 500 collected for the entire 12 month. In the same way, you have collected 2,40,000 for 10 months. If this was collected at the beginning itself, how much would have been the equivalent amount that you calculate? Okay, so that has been shown over here. See, look into it. So loan amount, you put the timeline of 12 by 12, 8 by 12, etc., etc. You convert that different timeline loan amount into one timeline loan. So this basically means 13 lakh incurred in different stages of the year is as same as 856,667 incurred for entire 12 months, because everything is converted to 12. I hope everybody are able to understand this. So 13 lakh incurred in different timeline of the year is as same as 856,667 incurred for entire 12 months. Okay, why are we doing it? Because your weighted average capitalization rate is per annum. So therefore, to apply it in a specific better way, you convert the loan amount into full 12 month. So now for capitalizing the interest rate, as I have told you, total interest divided by total loan, you'll get the rate 11.5%. So now what you need to do, entire 12 month utilization amount is 856,667 and the weighted average rate is 11.5%, and there is a 2 lakh specific borrowing that is automatically used only for construction. So therefore, now look into it. First, specific borrowing 2 lakh into 8%, because any borrowing cost incurred has to be capitalized. So of 8,56,667, 2 lakh is specific borrowing, the other part will be general borrowing utilization. So 856,667 is equivalent 12 month principal amount, of which 2 lakh is utilized through specific borrowing, balance amount through general borrowing. So that will give you borrowing cost to be capitalized. So for specific borrowing, you apply interest rate of that loan. For general borrowing, you apply capitalization rate, which is over here. So you are going to get the total amount of interest. Once you get the interest part, add it to the cost of the building, 13 lakh plus 91,517, it will get you 13 lakh 91,517. Now don't get confused. So why are we now considering 13 lakh again? Why not we consider 856? No, 856 is only for interest application. To apply the interest rate, we wanted a principal equivalent to 12 month. But when it comes to value of the asset, whatever cost is incurred will be capitalized. So 13 lakh is incurred. So 13 lakh will be capitalized. Along with that, 91,000 will also be capitalized. Okay. So this is how you need to capitalize general borrowing. So if this is a very famous type of question, so what should I do first? Calculate the weighted average interest rate. How do you get it? Total interest divided by total principal. Then if at all expenditures are incurred in different part of the year, convert that into 1 year, similar 1 year. How do you do it? Number of months divided by 12. After that, Once you get the total amount, part will go to specific borrowing, the other part is general borrowing. Specific borrowing rate is that only, general borrowing capitalization rate will apply. That is how you calculate the amount of borrowing cost to be capitalized. The second part of the question is pass one journal entry. For that they passed it as building work in progress to borrowing cost. Or else you can pass in one more way. Instead of building work in progress, you can write bank also. Instead of two borrowing cost, again you can write bank as well. If at all you assume that everything is already paid. But if it is not directly paid, then consider it as borrowing cost and then payment has to be made. So this is how you have to consider general borrowing element. Other things are easy to understand. Some extent students will feel difficult with how general borrowing capitalization will come, and I have tried to explain you as much as possible. So I hope everybody understood how this general borrowing mechanism is supposed to come. So with this, we end the